All right, everybody, welcome back to the Cashflow Chronicles September 16th. Mr. Patel, how are you doing this week so far?
After my last podcast with Sam, I'm gonna get ready for World War III. You know, us versus the robots. These guys, man, with this technology, they're too excited for the end of the world. It's like we're gonna get AGI, and it's like, why do we need AGI? Like, shit is working fine. Like, let's not let's not like challenge things. You know what I'm saying? Like,
I'm not that smart. I can't do that AI stuff. That's where you guys come in, right? You guys are the tech
nah,
guys.
bro, I'm not a tech guy. I mean, I use technology, but I don't like I find that like society, the more tech gets involved, the more society goes downhill. You know, like think about it this way. Back in the day, people used to talk to each other, used to go out and play, and now everyone's kind of just stuck at, sitting at home and, just not really doing anything extra with it. So I think about it and I'm just like, sometimes I'm like, man, I wish we could just turn all this technology off, but it's like Pandora's box. You can't get the demons back in again.
It's a blessing and a curse, right? Because it's never been easier to be able to do anything, right? Like it's never been easier to learn about how to invest in the stock market, how to do X, how to do Y, how to do Z. But at the end of the day, I feel like so many people get tied up in these other things that have been created, right? And it used to just be regular television, right? People would just be glued to the television, and
True.
but now they have their phones, right? And so the phone, you get people, and I do it all the time, my man. Like I'm on Instagram all the time doing the reels, and so anyway, I'm a
Dude,
culprit in that as well. So
dude, I love Charles Stewart's comment right there. I am a big Warhammer fan, so that totally resonates with me. Can you pull that,
Warhammer,
Justin?
is that a video game? I'm trying to remember.
Yeah, yeah. Well, it's not. It's like it's this entire genre. It's not just video games. They have video games. They have like collectibles. Bro, awesome. Yep. Is that a Chaos Marine? What is that? Which one is that on his
Looks like
thing?
something pretty crazy, pretty
Yeah.
cool.
So I've been playing Space Marine 2. It just came out, bro. Amazing game. It's been one of the best games like in the last few years. And I don't play a lot of video games anymore. I have been getting more into gaming only because I need
Need
I need
something.
like some mental downtime. You know what I mean? It's a Custodes Terminator. Nice. Nice.
Something
I find it weird. They're trying to turn into female Custodes, Charles. Dude, I am not with that. Custodes are dudes, okay? God, they're trying to go woke with Warhammer, and it's like pissing me off, man.
Everything
Whatever.
goes woke these days, man. We don't need to dive into that piece, but yeah, everything's
Yeah.
going woke these days. All right, everybody. September 16th, Apple pulling back 216, Amazon 184, the Bros 33.80, Google $1.58, Palantir hanging out just below $37, the Spy 57.2, sorry 56.2, the Qs 472. Bitcoin just below 58,000. Oil back above 70. That was surprising to me. We'll see if that persists as we had a lot of shut-ins due to the hurricanes. For those of you guys who are probably on the East Coast and Northeast, you probably didn't even know that we had a hurricane, but we had a hurricane in the Gulf, which shut in about half the production coming from the Gulf. So I anticipate that that's why the big bump, a couple percentage points, but I'm anticipating oil is going to continue to go down. But anyway, curious what your thoughts are. I know you guys were talking a little bit about the FOMC and what your thoughts are with respect to that. I don't want to belabor that too much.
Who
But
gives a shit, dude? Do you really care, Matt? Do you really care?
the thing I'm curious about is really how it's going to impact next year, right?
Mm-hmm.
At this point, you're up against such a wall here in 2024 that they're going to cut. Is it going to be 75 to 100 basis points before the end of the year? I heard you and Sam talking. Maybe it's up to 125 basis points by the end of the year. To me, it's more like, where are you going to end at the end of next year? And to me, why is that important? Because I have 3 houses that all have north of or 7% or north interest rates that I would like to refinance and get cash flow down on a monthly basis by, like, I don't know. I think refinancing all 3 of those loans would probably get me about, granted, I don't pay out of pocket for the 2 rentals, but because they cash flow themselves, but just my obligation, right? It'd probably easily go down by $1,500 between my personal residence, the other two houses.
As an exercise, let's do this.
Yeah.
When do you plan on refinancing?
I actually looked at the 10-year, right? So the 30-year mortgage rates, generally speaking, relies heavily on the 10-year 10-year treasury bond. And then there's generally a spread of anywhere between 1.5% to 3% on the 10-year. And so I was looking, and I think at best we might get down to like 2.5% on the 10-year, maybe 2% if we're lucky. And that's like if we cut way hard, right? I think we've already kind of advanced so much already that it's.
But before you continue, why aren't you refinancing it next week?
Next week?
Mm-hmm.
Yeah, I just anticipate that you're going to have further cuts in the 10-year. Like, I just think the yield is going to go down.
What about in December? Why wouldn't you do it then?
I'd be waiting for. I basically looked, and right now it's at 5.5% for Wells Fargo, which is the best that I've seen.
Mm-hmm.
I anticipate that. Well, I'm curious to see what happens with the cuts. Right? Is that actually going to impact and move the 10-year, or is the 10-year still so far ahead that it's going to take into the middle of next year before you actually start to see any impacts? So that's something that I'm trying to gauge as well, right? Like I feel like I have some time between now and in early next year to kind of gauge what's going to happen to the 10-year. And also there's a spread of about 3%, 2.5%, 3% right now on the 10-year. And normally it comes down to 2%.
So
like in
the reason why
time.
The reason why I'm asking you this question is actually, believe it or not, the answer is very predictable. And that is why we get recessions when the Fed starts cutting interest rates. See, whenever the Fed starts its interest rate cutting regime, a lot of people have always asked, like, why does the fall, like a recession start around the same time as rate cuts happen? What you just described right there, Matt, is the exact reason a lot of companies are not going to want to issue debt. Why are they not going to want to issue debt? Why would you issue 5-year debt right now when interest rates are high? Even if, like, let's say you wanted to build a building, or, you know, you wanted to build a new factory, or you wanted to expand, if you wanted to buy another company and do M&A, right? Right now would be the worst time to go do it. Why? Because now all of a sudden you're locking yourself up into higher interest rates.
Yeah.
So
prime example, Dutch Bros. Dutch Bros said we're pulling back. We're going to do 20 stores less because we're waiting for next year when interest rates are slightly better. They literally said that on the call.
Yeah. So that is the same thing that every CFO is going to be suggesting to their board this year and next year. And I think that's what causes a recession, where you're going to see a lot of cutbacks on capital, a lot of hiring decisions get pulled back. You know, you're already starting to see layoffs, right? So people are saying, you know what, maybe we don't need as many people, blah, blah, blah. And the thing is, that's on the backdrop of interest rate cuts. So, you know, a lot of people are basically discounting the fact, like, oh, it's a soft landing, we're not going to have a recession. And I'm in the camp of that. I think that's that we are going to have somewhat of a soft landing, but I don't necessarily think it's going to be, you know, like, oh, everything is going to be great, the market's going to get hit all-time highs in 2025. I think we need a year where we're going to see kind of like money rotating into like other parts of the market, right? And I think that's something to keep in mind, because there are opportunities in 2025 that are outside just the mega caps. I think a lot of people who are going to stick with the mega caps, they're going to underperform the rest of the market, you know?
Yeah. And then that's actually one of the good books that I read by Jim Cramer, believe it or not. I mean, he wrote, I think it was Get Rich Carefully, where he talks about the business cycle and what companies you want to be invested in during what parts of the business cycle. And so when the market's doing really well, you want to be invested in tech. When it's recessing, you obviously don't want to be involved in tech. You want to be in good things like basic materials and consumer staples and things that people are going to continue to look for and use, versus the discretionary stuff. That's always kind of the stuff that gets cut when there's any real bad, hard times. So he talked a little bit about that piece and the cycles of everything. And so I thought that was really, really well written on his part. And then I gave that to somebody and I never got to finish it. But that was a part that I took away from that book, which it makes sense, right? Like certain parts of the business cycle, you want to be invested in certain things. Like real estate right now could be toughish, but at the same time, you're going to have interest rates reducing. So you're going to have probably the prices of those things increasing, but you're also going to have real estate investment trusts not necessarily have to issue as many shares because their weighted average cost of capital is going to be going down. That's why you've seen, Brookfield go up. That's why you've seen a lot of these real estate investment trusts like Realty Income, Stag Industrial, a few others that I cover, go up because they're anticipating that the interest rate cuts are going to be favorable and they're actually, going to be actually making something versus if you think about it, a lot of those cap rates for a lot of those big facilities are 5.5% to 7%. When you have 5.5% interest rates, it's pretty difficult to actually make any damn money. So you have to just issue more shares and you're kind of sitting there with your sitting on your hands basically.
Yeah, I think this chart is a really interesting one. So let's take a look at this first, okay? When it goes to like the S&P 500, right? And you can see like the amount of money that basically the S&P with the yield, not this one, where the goddamn thing. Sorry. I think this was a good performance indicator one where you saw the total returns. Sorry. All right, well, we'll just discuss this basically. You can see right here, the S&P 500's relative return during a recession, like these are the recession years that they happened. Only a few of them, you really had a lot of outperformance. For the most part, recessions, they could be very short and they could be extended. The question is, are we going to have an extended recession or are we going to have just a quick down and then back up again? And I think like if you remember during the tech boom, we could see something like that where it's like about like a year and some change. So I think we have already been in somewhat of a recession. Maybe the data doesn't exactly point to it. So I'd say 2025 is just going to be a year of market rotations in the S&P 500 where mega caps might take a bit of a pull back a little bit and the other parts of the market kind of broaden out. And what you'll see is like flattish growth. So that flat growth is going to be it's going to be good for the overall thing. So I think 2025 we need to play defensive. And if you look at our portfolio, how are we doing on our portfolio?
Good question. I mean, I think the preferreds have done rather well. Let me pull them up. But I mean, I struggle, right? Like I'm always somebody that's always continuing to buy into companies, right? So when it comes to defensive, when I talk about it, it's more about, yes, I understand that, but I'm going to be looking for names that are getting beaten so that I can buy them for the next 5 to 10 years, right? Versus what I think you're trying to talk about is a little bit being defensive in terms of you don't want to lose any capital. I'm okay losing 10, 20% in a year. That's just how I know the market goes that way. And to me, I'm okay because I'm always adding capital to the portfolio. Versus some people, they hate seeing that red number and they really get bothered by it. So, to me, I'm okay. I know that sometimes you go up, sometimes you go down. For me, I've been up in majority of my portfolios, like my individual accounts, I'm up like anywhere between 35 to 50% this year. So if we end up down 10 or 20% next year, that's not going to be too big of a deal. I'm not ignoring your question, by the way. I'm just taking screenshots. So I don't know. I mean, to me, I think that there's a necessary evil when it comes to where we're at today, because for me, it's just obvious that some of these names have expanded in terms of their valuations, and it just doesn't make sense with where they're at today comparatively to the rest of the market.
Let's look at the sectors, right? So these are the S&P 500 different sectors in the S&P 500, and this is on a forward PE basis. Okay, you can see here that Great Recession, they basically had bottomed out. They were down to like the 15s. Prior to that, there was during economic expansion periods, they went from about 15 multiple to the 25s. If we layer on interest rates on top of this chart, it could get even more interesting. But the point is, usually for like, let's say something like consumer discretionary, I'm just going to give an example. You could safely say, depending on which industry you're looking at, something between 15 and 25 being somewhat of a a normalized multiple. So you can see here that if you look at on consumer discretion on a forward basis, there's not a lot of opportunity. You look at the next one is like consumer staples. The consumer staples is it's not cheap, but it's not like super expensive like we had in 2020. But 2020 was just, not 2020, sorry, 2000 was just on another level. And then eventually things kind of like moved down into the pattern. What other sectors do we have? Energy. Like energy right now is really down, especially on a forward basis. So maybe there's some opportunities in energy that we should be looking at, because if you look at energy, but the one thing I don't like about energy is that it's super cyclical. Like it has these moments where shit just goes freaking crazy and then it comes back down. And the thing is, like, cyclicality is not like, it's not like something I like investing in, because the thing is, like, you can't really determine how to navigate Saudi Arabia, blocking ships, or the Iran launching like some kind of like Houthi attack on the canals and getting oil prices up, or the Russian oil thing. So energy is one of those things where I like, if I play energy nowadays, I don't do common equity. I'll just do like debt, or I'll do like or MLPs and stuff like that, that make more sense because they're not necessarily as cyclical. Financials right here are, financials here was the opportunity when it was like around 10s, 11s, 12s. PEs in the financials. If you look at the regional banks, a lot of the regional banks were trading at single digit PEs. They've all been going up. So maybe there's a little bit of value left in the financials. Healthcare is, PE is up there right now, so not a lot of opportunity here. So the point that I'm trying to make is, it just seems that there is not a lot of opportunity anywhere, because on a historical, like at least the last 25 years, historical basis, valuations are, rather elevated. You'd really have to dig down, like information technology, IT, which is like, tech in general. Tech is trading at really high multiples relative to its past. And this is, remember, this is on a forward basis. This is not on current, so it's on a forward basis. Materials is on a higher side again. Real estate. See, this is also another one, but then I don't know. Real estate is going to be very subjective, because there's multifamily, there's office, there's.
But the problem with the problem with real estate is, generally speaking, you don't measure it using a price to earnings most of the time.
Yeah.
You measure it using a price to funds from operations, because
good point.
And a lot of people need to take into recognition that a lot of these industrial companies and high capex companies also have this as well, which is they have the ability to depreciate a lot of those large cap expenditures. And so with real estate, when you think about it in that perspective, it's like, you can't just be like, I've had arguments with people over the past 10 years. I can't tell you how many, with like, oh, it's got a 50 PE. I'm like, that's useless. Like the PE in real estate doesn't matter. But you have to think as well, like with oil companies as well, because they invest about 50% of the money that they make every year into CapEx. That's just a large drag in depreciation. So when it comes to net income, the net income actually isn't there. So sometimes you need to look at these companies on an actual cash flow basis, and price to earnings actually gets manipulated, especially for like one-off tax items and stuff like that. So you have to keep that in mind. Utilities as well, right? Very high capex industries. And so sometimes they might artificially look high, when in reality it's just due to the fact that they have a high depreciation, artificially decreasing their net income and that allows them to save on taxes. So
so now it's a stock pickers market, basically. It was before, it was, hey, just buy the index and you'll be fine. Now it's more like, hey, you got to find the companies, you got to do the work, find the great companies that can produce that alpha now, and and do well. Industries too.
It's a little bit more difficult, but going to the portfolio, so blow it up here for you guys. So it's situated based off of current value being the largest, so the largest position down to the smallest position. So we're sitting at about just under $4,500. A lot of this comes from the increases in a lot of the preferreds over the past few days, and then also we've seen a little bit of love coming from the cruise lines, believe it or not, because they were back almost down to the low single digits again, but they've reversed and have done rather well, probably because we're on the precipice of these interest rate cuts, right? NEXT is back above $5 is also, I think, like minus 25 or minus 30. HIMS has actually come up again. Bitcoin's actually not too far off, but the things that are really still dragging us down, but they're small positions, are Celsius and ABCL. So, thoughts?
No, I like it. We're doing well in the portfolio. We're gonna get a nice little divvy from PN and PM at the end of this month, and then also some YouTube money that'll come in hopefully. And we discussed a plan on what we're gonna do with it. We're gonna apply it going forward, and it's a lot of value here, so it's good. What are we looking at here today?
What do you think?
I say we hit that 50, man.
It's hard to say.
Yeah.
If you include the 2% today, we might be there. But we're at 47 flat, but this is up until obviously Friday. But we had 2% up today. So we're probably getting close. I'm not
a fan though, man. We're not doing good. We're not up three times the S&P 500. Goddamn, S&P 500 just came at us. It's at 19. That means we got to get to 60%.
It's because we never sold HIMS at what was it when it was up at like 22?
Yeah, we sold a good portion of it.
We sold like 2/3 of it. We sold like 2/3 of it.
Yeah, we did that. I mean, look, once the other money gets added in there, it'll be. By the way, did you see that video that what's his name? Joseph Carlson put out?
No.
The one on Twitter. Okay.
I saw you commented on it, but
yeah, so basically so right now everyone is looking at our portfolio and saying, "Oh, you guys are doing well." The thing is, it's really hard to try to quantify. Like the question is on there, is it time weighted, Matt, on the thing on your Fidelity, if you want to take a look, because it's total return and then like time weighted. So the thing with Joseph Carlson is that he started at, I think, like $2,000, and then he grew the portfolio to almost 750. But it's not like his total return was like like from 2,000 all the way to 750. But he's been adding. So a lot of people are like, "Oh, your returns are not that great."
Well, that's what this is, right? This is we only are showing a 5% return on the portfolio, right? So that includes like us buying and selling stuff, and this includes just the cost basis versus this number only includes how much we put into the portfolio. So since October of last year, 2023 to now, we've been able to grow by 47%.
And that's year to date. Do 1 year, because I think we started.
I don't know if we're at 1 year yet, but let me see.
Yeah.
No, we're not at a year yet. It won't show anything. But the year for the S&P is 28%. So hopefully within a year's time, it'll probably be really good because we did take a little bit of a hit in the first quarter. I think some things flattened out for the first quarter. So like Celsius did pretty well for us. I don't know if we had too big of a Celsius position in the public portfolio though. We might have. I don't remember. It's been a while. But yeah, that's the hard part, right? Is like when you look at those returns, sometimes it gets a little tough because you have to think about what actually. Let me see. Does this show balance?
If you go to Fidelity, right? Go to performance, and then you should see time weighted, because I think the time weighted will give you an accurate picture of what it is. It usually breaks it down too.
Yes.
If you go to more, and you'll see, like, if you go to accounts, go to the top, and then you can go to that specific account and go to performance.
Yep. Here we go. Let me just double check that there's no account numbers or anything in here.
Yeah.
I think we're good. So this shows people why the year to date is the way it is.
Yeah.
Shows monthly. Yep. So this is up until let me make a slide, put that in here, and then share. So this is what you can see since the January 2024. So basically 9 months that we've been at it. So we started at 1,000. We've added to 2,300, and we're up $879, which gets us to that 43. So you can see the divergence. Like I said, we kind of pulled back a little bit in this April-May timeframe. Not exactly too sure, but we've kind of been flat in terms of our distance away from the growth that we've had for the past 3 or so months. It's been hanging out in the 40s.
Yeah.
So we need the next leg up. I don't know what it's going to be, but
well, let's see, man. Maybe we'll get to that. Like I said, the 10,000 mark it'll be our first like little achievement that we just got to 10,000.
Yeah, that'll be fun. I mean, especially now that we're starting to get a little bit of more dividend income, like $4,300. You're starting to think, what's 4,300 times, I don't know, let's just say 0.05. I mean, you're starting to get a couple $100 a year in dividends, and then plus we're hoping to get $100 a month in doing this thing. So we'll see how it goes.
Yeah,
with that. But yeah, interesting. So curious to hear, because we did talk a little bit about it, and I don't want to divulge too much about other things that we discussed, but we did say that we would chat about NEXT, maybe not to the full extent, but I don't know if you still want to chat about that, or if you want to hold that off.
I say we hold it off. I'm doing a little bit more like in-depth research right now. And the thing is, I want to make sure I understand everything. And then we could kind of like talk about it, and then probably talk about something that we were talking about this weekend about possibly making a visit to Brownsville, and just essentially, seeing what's going on and seeing, because I think there's a lot of developments that are happening in that area that are not necessarily going to like impact this project. Because I mean, it's such, you know what, let's talk about it. Frick it, man. There's no point in trying to keep it away from it, so why not? So I think the project itself just got some new life put into it by basically FERC just saying, you know what, we are actually going to we're gonna what is that thing called, we're gonna just do the supplemental, and the supplemental looks like it's the target date for the approval post supplemental is going to be like next October. Now the thing is, it all depends on like the construction timeline, right? So are they going to pause construction for a year? Because if they do that, that's not good. So I'm right now, the research that I'm doing is just that in itself. I'm trying to figure out, like, will they let construction proceed while all of this is happening, and what is the status of the appeal? Because I know that they were trying to appeal it. So these are like the fluid things that I'm trying to figure out right now over the next, few weeks, and we'll go from there.
Direct statement from the company said they're going to continue construction unless it's upheld in court, right? So they never said anything about, they're going to stop construction. All the statements that I've seen, which I don't know, like you said, like, I don't know if they're going to force them, if that's going to change within the next month or two, but to me, it makes it feel like Texas LNG is kind of going through something comparable, and they're able to continue construction. Same with Rio. So it seems like they're okay. And I think that there's just too much money tied up for them to actually pause, right? You have the Middle East countries involved now. And believe it or not, actually, I saw some pretty crazy stuff about the Middle East, countries like Saudi and ADNOC getting involved in some of these Gulf Coast projects with Exxon. So even more data coming out about how much they're diversifying away from the Middle East. So interesting to hear about.
Then there's also like national security too, because the thing is, like, if you look at the opposite end of the spectrum on who supplies LNG outside of the US, you can see the majority of it is coming from Russia, who's doing direct pipelines to Europe, which are all being kind of cut right now. And the other one is Qatar, who's pretty much been, I don't want to say proven to be a sponsor of terrorism, because I mean they have a history of that, where they've essentially funded terror groups in the Middle East. So the question now that we all kind of have to ask ourselves is, do we want other countries basically benefiting from our heavy-handed regulatory environment? Because the thing is, decisions like this are heavy-handed, and then what that does, it creates like a secondary impact where other projects that are currently in the process of going through FID may never get there, because the risk of basically projects stalling out and capital running out are too great. So now it means that a lot of other companies may not want to do that. They're just going to say, you know what, we don't want to finance any more construction of LNG terminals. So I think this will set up a very bad precedent if these projects don't go through now, especially because FERC gave them the approval and said, go ahead, So even though like the DC court ruling was punitive to next decade, technically speaking, it was directed towards FERC. It wasn't necessarily the company itself,
Right. Yeah, I think it's interesting. It's a lot of things that you never want to see. You never want to get tied up in litigation, because there's always some sort of risk that you may or may not be able to quantify, and that's kind of what we're dealing with here, right? While we have an idea, right, nobody really knows for certain what's actually going to happen. So makes things a little difficult.
Yeah, but the upside is there, man. So if everything goes, right, we could see some substantial upside. So, this is one of those things that's like a binary trade. So this is not like something that you would park a whole lot of money into and be like, oh my God, I'm going to 20x my money. Yay. It's more like, hey, you know what? On the barbell, where basically you have most of your money in secure stuff, and then you have your money in shit that's like got 20x potential. It's in that category where you're going to keep. By the way, do you know what the barbells? Of course you do. Do you guys know in the chat what the barbell strategy is when it comes to investing? Matt, you know, right?
I'm curious what you mean. Yeah.
Okay, let me show you what it is. So it's a very simple thing.
I feel like you're gonna say something like, "Yeah, I'm dumb. I know exactly what you mean," but for right now, it's not hitting.
Yeah. So when you're investing and you're trying to like manage a good portfolio, what you want to do is you want to do two parts of your portfolio. Right here is large investment in safe, low risk stuff, right? And then right here, a small investment in high risk, high payoff stuff. So what ends up happening is, like, let's say right now you would keep 90% of your money in like low volatility assets that go higher over time. But then also you don't want to, you want to kind of like, if you want to outperform the market, you want to make sure you're taking these bets. So what we spoke about before about, starting an ETF that's 75% allocated towards the S&P 500, with the other 25% looking for those crazy opportunities in the market. This is how you would actually outperform the S&P 500, where majority of your money should be in high quality index funds that are low fee index funds. But then you also have this subsection where you can have outstanding returns, right? And basically that outstanding return potential ends up letting you outperform the general market,
Yeah, that's the hope for me. I mean, that's generally what I've started to get more involved with, which it used to be more all around dividend investing. And then I said, you know what? I'm just going to invest in majority of my capital in the S&P. It's getting too large for me to manage, from like a day-to-day basis, right? Because I don't have the time to look at it. But what I can do is look at 3, 4, maybe 5 investments that I really want to concentrate in, right? So that's generally where the majority of my capital is, right? So I have a lot of the S&P 500 for the majority of my funds. And then I have 4 or 5 big companies that I do a lot of research in that I hold. And that's like the Palantirs, the Rocket Labs. Some of those have kind of had minds of their own at this point. So I don't even really have to concentrate them on too much. But I have a strong feeling Palantir will pull back here. A good percentage. It needs a little bit of a breather. But that's, I guess, a different conversation for a different day. But okay. I did want to take an opportunity. We do have 228 of you guys hanging out. Appreciate you guys very much. Please be sure to like and subscribe. Chris and I try to do 2 of these a week. Sometimes we can only get 1 done, but hopefully you guys are getting a lot of value out of this, and please share with friends and family as well. Back to you, Mr. Patel.
Yeah, man, I think we need to just keep at it what we're doing. It's been successful so far. There's, when things are working, you don't need to like keep looking for new opportunities and all this other stuff. So lately I'll be honest, I haven't found a lot of great places to park capital outside of the ones that I have. So it's like, from a content creation standpoint, it kind of sucks, because you're just like, what do you want me to say? Like, the shit that we have is good. Like, I can't really make, like, why try to break things? Like,
you can't create drama just for the sake of drama. Yeah.
Right.
Yeah.
And this is the thing that I hate about like content creation, like with like, the finance YouTube space and stuff. People are always either looking for the next big thing. And it's like, bro, maybe there's not the next big thing. Maybe it's just like, you got a thesis, let it play out, do your thing and just chill, So that's the plan right now. Let's just chill,
Yeah, that's what I'm for. I think sometimes so many people just have like ADD when it comes to this, and they fondle their money, right? And what happens when you fondle your money? It's like soap, right? And think that you've talked about that in the past, where it's like, if you fondle it, you're just going to get smaller and smaller and smaller because you have so much inefficiencies. It's like, it's down 2%. Maybe it's not as good as I wanted it to be. And trust me, I'm not saying I've never done it. I've done it. I've invested back in Meta back in, what was it, like 2014 or 2015, when it was $70 a share. And Meta never did a split, did it? No. So I remember having like 20 shares of Meta. So it wasn't a lot, but it was a lot to me back in 2014 or 2015. It was right after it IPO'd. And I was like, man, it's $70 a share. And then it didn't do anything for like 2 months. And so I sold it. And same thing with Microsoft. I remember buying Microsoft back in 2015, right before Satya Nadella came in, and it was $50 a share. And I had like 20 or 40 shares. I forget what it was. It was below 100 shares for sure. And I was like, this isn't fucking doing anything. Old ass dinosaur stock. Like, let me invest out of it. Let me do something else. And this is obviously before cloud started getting big and right before Satya took over. So I'm an idiot, right? Had I had that vision and knowledge, but it goes back to this being like the churn, right? The focus on the wrong things, right? If you don't know what you don't know. And so when you have so many different things that you're keeping your attention on, it's very difficult for you to truly acknowledge and go into enough depth and detail and due diligence and understanding of the risks for each individual investment. So you end up making a mistake because you're trying to spread yourself too thin. And generally speaking, if your money, the way I look at it is, and I say this to all people all the time, there's a lot of opportunity cost in a lot of different things. But basically the thing I was trying to tell people is like, opportunity cost also gets involved with, your personal finance as well. And what do I mean by that is, it's like, so many people I know are like, I want to do this hobby and that hobby and the other hobby. It's like, I have one hobby, and that's investing in the stock market. So maybe I'm just biased here, but generally speaking, I know everybody that'll try to buy like a brand new surfboard and like a 4x4, like off-road ATV. And then they want to buy like a motorcycle. And next thing you know, you're spending hundreds upon hundreds, if not thousands of dollars a month on stupid shit that, one, you're not going to use, two, you don't even care about. When you love fishing, you could spend half the amount on fishing and you'd probably be just as happy, if not happier, than having all this other stuff that's just clogging up your garage. And so I feel like it's almost comparable. It's like sometimes you need to focus a little bit for you to really to get value. And I think that's one of the things that I always kind of screwed up on. I've had a lot of, I don't want to say a lot of home runs, but I've had some home runs like BHP. And a lot of it was because I was early in my career. Like $2,000 used to be a lot of money for me back in 2014, 2015. And so I was like, oh, I had $5,000 invested at one point, BHP. And then when I got back to even on those first 100 shares that I had bought, I sold them and I just let the other ones ride. And that was probably my best returning, other than Bitcoin, my best returning asset since 2015 timeframe was BHP. And I think I returned like 350 or 400% off of that due to all the dividend reinvestments and special dividends that they paid out over the years. But I feel like so many people, they lack a strategy. And it's not to say that your strategy and your plan has to stay that way. It can mature as your portfolio matures. But the problem is so many people are running around without a strategy that they end up fondling. And they'll be like, oh, I need to do dividends. Oh, today I'm doing, I'm selling options. Oh, today. And then they don't have the maturity of an investor as of yet and seasoning of an investor as of yet to be able to juggle so much, because it's like college, right? You're trying to learn math, you're trying to learn physics, you're trying to learn everything. And it's hard to like remember absolutely everything that you've learned unless you've kind of gotten that piece and that muscle built around a specific way of investing. And it could very well be that strategy just doesn't work for you at all, right?
Yeah. This is my returns for like, the thing is like I moved brokers. So if you want to share it, I moved brokers, so I can't really like show you the other things. But basically, I have multiple accounts, and basically since 24, like this is up 3 months. This is on a time weighted, so I'm up about 280 in one of my portfolios. The main one that I have is this one right here. So I'm up almost 269% on that since 2021 of January. But the thing is, if you look historically, this is not repeatable, by the way. This is like, we got really, really lucky that we were able to kind of capture this kind of return because a couple of things. One, we came from such a low with COVID. And then after that crash, things that were like Meta and all the other stuff, they had gone super, super undervalued, So there's a lot of like, when the market is in favor, man, you should be really willing to just strike hard, because like these few years that you have can really outshine the shit out of the total thing. So if you look at the S&P 500 in the last 10 years, it's up on a time weighted basis, 238%, right? I'm beating them, but it's only in the last 3 years since 2021. So the question is, okay, like how did that happen? Well, the thing is like this naturally will go down over time, because what's going to happen is I'm not going to be able to get crazy returns like this all the time. I mean, hopefully I do, but it's not going to always be the thing. So my thing is wait for opportunities where things can get really, really juicy and just go crazy with it. So if you look at like Buffett's like the times where he's made the most money is when things have been really just oversold and he can chill. So I bring this up because right now, if you look at the market, the valuations on a lot of things are just kind of elevated. So, you want to look for different asset classes that may end up, benefiting you in the long run that are not necessarily as visible. And just broaden your horizons a little. Don't look at just the mega caps and that's like the only thing to focus on. Look at the other stuff that's out there. And also the S&P 500 over a long period of time does really well. So focus on that.
Really well. Yeah. I think the thing that bothers most people is, and this is something that I've taken with me, and this is hopefully something that'll pan out in the next 18 months, is I've always focused on when the S&P goes down by a certain amount to try to refocus into the S&P. So if you have, let's just say you have a bunch of cash on hand, like I always carry 10% cash in my 401k for some reason, but I generally use that in case there's any big pullbacks. And it worked really well during the pandemic and it's worked really well in like 2022 as well, where if you have like a 10% pullback, it doesn't happen so often in the S&P, right? It might happen once a year, maybe every 18 months. And so if that's the case, then I generally take 15 or so percent of that cash and move it into the S&P. If you go down 15%, I add another, I forget what it was. I'll have to pull up my journals. But generally speaking, it's like by the time you're down at like 40 or 50% in the S&P, you should probably be fully deployed, because very rarely do you go down more than 50%. So for me, it was like I was looking at that, and I did that it was probably one of my proudest moments as an investor, because I was freaking out, right? I think I had like $410,000 February 2020, which to me back then was a lot of money, right? I was like 28 years old, 410 grand. I was like, I'm the fucking man. So obviously a lot of that was in the S&P. I did have some other oil stocks and stuff like that. They got absolutely obliterated, but I dollar cost averaged out, into 2020, into 2021. But for the S&P 500, what I did in my 401k was I did just that. And by the time we got down to like 30 or something percent down during the pandemic, I was like, I want to say 75% deployed in that cash. And so I would want to do and deploy a similar strategy. And one thing that I always looked at in the past, which I never deployed during 2022, which I regret looking back in retrospect, was we always talked about it. Me and a few other buddies that I used to invest with back in 2020, 2021. It was like if TQQQ in the NASDAQ or whatever pulls back drastically in 2022, or just in general, start dollar cost averaging into TQQQ. And I did a little bit, but it wasn't enough where it made me life-changing money, right? And that was kind of the problem. And it was really obvious, right? You've just gone up to 2021, $80 a share. You start having a pullback. It's like, well, you're down at 17, $18, right? You're pulling back pretty hard. Why not dollar cost average? And it was kind of stupid of me not to dollar cost average as much as I did not. And unfortunately, I did some, which I should pat myself on the back for, but my cost basis on TQQQ is still not where I'd want it to be. So I'm kind of looking forward to another opportunity to do that, because, hey, man, I add a crap ton of money to the portfolio every single month. So,
yeah. Dude, here's a question. Do you think Berkshire Hathaway outperformed the S&P 500 over the last 10 years or no?
They were struggling before they made their Apple investment to outpace. And then I feel like with the Apple investment, that really ignited their returns again. So in terms of the last 10 years, I would say I don't think that they massively overperformed, but they either slightly underperformed, met, or slightly overperformed. But it wouldn't be like by hundreds of percents, right? We're not talking back in the 70s, 80s, 90s, early 2000s, where he was getting annualized 25%.
So if you look at this, so Berkshire in the last like 5 years has basically, like most of the time he's outperformed on a 10-year basis, but it's not like a lot. So, if you had just put your money in the S&P 500, you would have like performed a little bit less than the greatest investor of all time, Warren Buffett. So it just goes to show you that, even the big guys sometimes can't, but historically Berkshire has done better than the S&P. But once again, there have been times where, Berkshire's underperformed, and they've underperformed massively. And so this is why it's never easy to stay like this. And the only people that really make really, really good money, like if you see like Bill Ackman and all these guys, they're billionaires not because they picked good stocks. It's because they picked good stocks for people, and they were able to get a commission from that. And that's mine and Matt's goal eventually, where it's like, okay, listen, we will figure all that stuff out. You just put some money with us and we get a cut, and we'll get a nice little cut from that, and you'll get good returns. We'll get good returns, and hopefully we can create craft strategies that are beating the S&P 500. So,
the thing that I would love to do most is really just get people on the right path, right? I think so many people don't invest enough monthly. They'll put $1,000 in, say, I'm done. I can make this $1,000 grow to $1 million fucking dollars. And it's like, no, you can't, man. Like if Warren Buffett, I doubt Warren Buffett could even grow $1,000 to $1 million. Maybe he could actually, but somebody inexperienced that has very little experience in the market to be able to just be like, yep, here's my $1,000. This is the only $1,000 I'm ever going to invest, and think that you're kidding yourself, right? It's about consistency. It's about always contributing to the portfolio. And when I become a registered investment advisor, that's really what I'm going to try to do with people is like get them set up, be like, so what are you investing every month? They're going to be like, this is my only $1,000 I plan on investing. And I'm like, so how much can you invest every month? Right. And just try to get them to flex that muscle of and understand that it's like consistency. Because I anticipate you didn't just start off and put 10 grand in and you were just like, yep, I'm going to trade this 10 grand to grow into millions of dollars. I'm assuming saved a crap ton of money and lived frugally and, ate peanut butter and jelly sandwiches or ramen sometimes just to be able to get, enough money in the market early enough. Cause you're like, time is money. Right. So.
Yeah. All right, brother. I think that's it for me today.
Cool. Well, thank you for the 155 of you that showed up on YouTube. The one of you that always shows up on Twitch, much appreciated. Please be sure to hit the subscribe button. Share with friends and family. Mr. Patel, do you have anything before we log out?
I would say look beyond the S&P 500. Look beyond the mega cap 8. I know that it's sexy to be in those companies, but right now I think there's a rotation happening. And we will do our part to try to cover some of those names that are going to benefit from this rotation over the next probably 6 to 9 months. But then also we're going to be talking about some different asset classes. I think that is something that's very like a key that other people are not going to like. Pretty much retail doesn't talk about things like bonds, preferred equity, even maybe some option strategies too. Because the one thing that we haven't really done in our portfolios is options. And I'm not sure I actually want, you know what, I take that back. I'm probably not going to share any option strategies on our Cashflow Chronicles thing. Because the thing is like, there's too much, we don't do the podcast enough, and options are very like time dependent. So there's times where the option makes a lot of sense, and then there are times where it doesn't make sense, and you have to know when to get out. So it's not
maybe when we have a larger portfolio, like closer to 100 grand, and there's some small companies that would want to potentially make some moves on. But even still, like 100 shares with 100 grand can be eaten up pretty quick. So you have to have a pretty significant portfolio to do like cash secured puts and things like that.
Yeah,
but you can do buying and selling. But I'm with you. Like it's not my forte. It's not my game.
Yeah.
There's a lot of people out there that are a lot better at that than I am.
There's too many copycats, dude. That's the one thing that I hate about like social media and finance, combining it together. And it's people want to just copy your trades, be like, oh, you did it, so I'll do it. And it's like, no, don't do that. The reason why is because I can exit and you won't know that I exited, and then now you're stuck holding the bag. So number one, that's a problem. Number two, the problem is I have a different risk tolerance than you do. I also make a different level amount of money than you do. I'm at a different age than you do.
Yep,
so
100%.
You should never try to replicate me exactly. Now, can you say, listen to these guys and then, make your own judgments, go into the research, and learn how to invest yourself? Because I think that's the goal that everyone should have, is like learn how to, and then believe it or not, I'm not a genius by any means. Matt might be a little bit of a genius, but I'm not a genius at all. I
have so many blind spots, man. Like I tell people straight up, I'm like, I don't follow that stock. I don't know that stock. I don't do that strategy. I just, I think there's something to be said about kind of understanding where you're at, because when you're new, you want to try everything, and you soon realize that sometimes things are your game. Like I know some people that all they do is shit stocks, like shit.
This is why I hate Kramer, dude. Everyone just calls into, hey, Kramer, what do you think about this company? And it's like, you think Kramer's got time to fucking sit there and do like all these analysis? But he's so like, I think it's a good company. Motherfucker. Like, there's no way you know every single company at all times. I don't understand how this guy's been getting away with it for the last 15 years, where people go, "Hey, Jim Booyah, dude, what do you think about Texas Road Pacific?" And it's like, you think this guy is like doing any in-depth research? Like, what? You know? And then people ask why they underperform the market, because you're fucking calling in to this idiot, basically.
I think there's something to be said about getting in, getting out, because they're calling in and he says it's a buy, and it very well might be a buy at that point, but it might be a buy. You have to think he was a hedge fund manager, so he would be in and out of a stock potentially in the matter of a couple weeks, right? A swing trade or something. Some people are potentially like, this is going to be the one that gets me to retire, man. Like, this is it. This is the number one. And it's like, dude, it's Union Pacific. Like, I get it. Like, like Union Pacific's a great company, but I mean, is it going to fucking 15x your 10 grand that you need to get to retirement? No, it's not. So like, you know, I think you know, you need to have some realisticness. And I think sometimes people get so fired up that, like, there's so many people at work that I talk to, and I'm just like, you know nothing. But I don't want to be that guy that's just like
you know nothing, Jon Snow.
Yeah.
Yeah. Did you get Tevis to stop putting money into SoFi yet? Did you try? Did you do your
No? I haven't.
What is man? I feel bad for these guys. I feel bad for the SoFi people, because like they missed on so much alpha because they're so fixated on this one fucking company, man.
Their time will come. Their time will come where SoFi will do well. I mean, especially in this. I don't know if it's going to do well.
It's the next Palantir.
Exactly. When it gets into the S&P 500 in the next 2 or 3 quarters, right? It'll blow up. But yeah, Tevis, I think, probably just looked at the 2027 leaps and went full port. So
he did. He put it on Twitter that he bought 2027 leaps, the $15. I was like, Tevis, why are you doing this? Like, I don't know, man.
I don't know.
Whatever.
All right, dude. All right. Well, much appreciate everybody. I'll send us off with our favorite outro. Take care, brother.
Later.
Greed is good. The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.